Welcome to the Daily Brief. I'll go over the action in the market for Friday, March 10th, and then we'll see how things look for Monday, March 13th. We had another significant down day, and if we were short-term and intermediate-term oversold before Friday's session, we're even more so after Friday's session. But that just shows you that when momentum goes in one direction or the other, it can carry over and get to the extreme reading fairly easily. The initial reaction to the employment situation report was positive. The futures had bounced up slightly, but by the time the cash market opened in New York, we were down negative. And there's a lot of stories working their way through the market right now that are causing some real fears. And when there's a lot of fear, people get out of stocks and they're starting to go back over into bonds. So let's go back and talk about what happened. Right at the open, we had a gap lower open. Prices fell down to S1 at 38.79. They were able to rebound all the way above the unchanged level, but then they hit resistance just below the 200-day simple moving average, which currently is at 39.40. As the day went on, prices fell back below the unchanged level and all the way down to S1 before finding support at 38.50. Prices then rebounded back above S1, but fell back down to 38.50 going into the close. So we were down 1.45% on above average volume. We've seen two strong down days on above average volume. That just shows that there's more intensity to the downside currently. The technicals are still quite negative because of the inflation and interest rate scenario, but also some of this bank closure and what's hitting the financial sector is also becoming part of an issue. Here's the intraday chart showing how we gapped lower. We came all the way down to S1. We were able to rebound up off of that and fill the gap. We actually went positive for a brief period of time, and this red dashed line is the 200-day simple moving average. That was the high for the session. We fell back down below the unchanged level, eventually down below S1, all the way down to this 38.50 level before bouncing up to S1 and then coming back down to 38.50 and closing up off of that in the session. What are some comments that we can make? The employment report, it was taken positive with non-farm payrolls being stronger than expected. That didn't really concern the market, but what the market liked initially was the average hourly earnings growth. It was weaker than expected, and I'll go through that report here in just a moment. The S&P fell below 3,900 on above average volume, so that's a bit of a concern. Bank stocks continue to lead the market lower. On a short-term basis, our list is getting longer. We have the advanced decline ratio, the rate of change going back 5 periods, the stochastics, the Stoch RSI, and the Williams percent R. They're all extreme negative. On an intermediate term basis, we have the VIX, which hadn't been moving all that much. Well, now it's kicking into gear. The Arun oscillator that I'll show you, the moving average study, the McClellan oscillator, the PMO study, the CCI based on 14 and 20 periods, as well as the RSI 9. What had been giving some support to stocks was when the dollar goes down and interest rates go down. Well, that happened on Friday, but that didn't give any support. It was folks getting out of stocks and going into bonds. So that pushed stock prices lower and drove up bond prices. We still have all of our yield curves that remain inverted. Sentiment, we're now getting to the extreme negative camp, where we're at a reading of 24, where we dropped 10 points down from 34. Our trend is negative, but now it's starting to get stronger. The ADX is picking up the start of a trend here. We're getting to the point where we're crossing above that moving average, but we're still below 20 overall. And our bias is negative since we had the down day, and our momentum is negative because we've had the last couple of days that we're down. Looking at the economic reports, here's the employment situation report. We had non-farm payrolls come in at 311,000, a lot stronger than the 205,000, but a lot less than the 504,000 that they had last time, and that even came down. It was 511,000. They revised it down to 504,000. The non-farm private payrolls came in also stronger than expected at 265,000, where they had expected 203,000. Last time, it was at 486,000. The unemployment rate actually ticked up to 3.6%, where they expected it to be unchanged at 3.4% as it was last time. This is the part that the market picked up on that was initially positive. The average hourly earnings were up 0.2%, where they expected it to be up 0.3% as it was last time. And the average hourly work week fell a little bit too to 34.5, where they expected it to be at 34.6 as they had last time. We also had the Treasury budget come out, not a real big market mover. It was at a minus $262.4 billion. Last time it was just at a mere minus 38.8 billion. Some of the information that's coming out right now is that SVB Financial, it was halted. It never did trade in Friday's session. And this is the Silicon Valley Bank, and they've decided to go ahead and shut that down. The FDIC came in and created a Deposit Insurance National Bank of Santa Clara. The goal is to protect insured depositors of Silicon Valley Bank. And also the Founders Fund came out and advised companies to pull all of their money from Silicon Valley Bank because deposits were going out a lot more than any money was coming in. The reason why this is really making the news cycles is not only because of that situation, but there's fear of a contagion, that it'll start here and then be like dominoes, that it'll go not only through the banking industry group, but then into the financial sector and then possibly nationwide and even worldwide, similar to what happened in 2008. And while this is happening, the markets are experiencing what's called a flight to safety. They're getting out of stocks and they're going into bonds. So far, the talking heads are saying that this situation is not seen as creating some kind of systemic banking problem. But we'll have to see. As this unfolds, are there going to be other banks that get sucked into this whole problem? Just to update things with interest rates, this is where we were a week ago. We're a 71.6% chance that we'll have a 25 basis point hike at the March 22nd meeting, with only 28.4 believing that we'll get a 50 basis point hike. In the past week, then Chair Powell came out and gave his testimony before Congress. That immediately switched to a 72% chance that we'll go up 50 basis points. And then this is how it stands after Friday's session. We fell a little bit to 68.3, but still the odds favor a 50 basis point hike. The Ulster Index is continuing to drop down. We're seeing some life in the VIX finally, but now this indicator is starting to trail off a little bit, showing that fear of subsiding, but that's not really what we're seeing in the market. Here is the VIX on a line chart and on the bar chart. It really spiked up. So this idea, when the VIX is low, it's time to go. Well, a lot of people went on Friday. And here's the VIX of the VIX showing how volatility has just really spiked up, both on the line chart and on the bar chart. Here's the ADX showing how we're crossing back above the moving average. We're still below 20. So if you're more aggressive with things, you would then default to the negative trend. If you want further confirmation, you would wait until this ADX line crosses back above 20. Here's the RSI 9 period on the VIX showing how we've gone up pretty far, pretty fast. We could still go higher. And we may work off some of this condition as the VIX continues to go up if the market continues to decline. Here's another indicator that's showing a little bit of life. This is shorter-term bonds to the S&P 500 equal weight ratio. When this is going down, that means that fear is decreasing overall. Well, we're seeing it spike up a little bit in this latest reading. Sometimes I don't find this chart all that useful, but right now with it spiking up, it seems to be confirming what we're seeing in the market. The daily chart is showing how we finally broke down below this trend line and closed below it. We also closed down below the S1 pivot level. And then on bottom, you can see where for Thursday and Friday, we were able to get back above average with volume. Here's a 2-year look at that same chart showing how we broke down below this trend line on an increase in volume. Our rune is showing that sellers are really in control. That's pegged in the top. We're seeing buyers really decrease. So our oscillator on the bottom is starting to give us an extreme negative reading, but it is negative overall. This is showing how growth has been holding up slightly better than value. They're both going down, but with large caps, growth was down 1.4%, where value was down 1.49%. You can see across the board where growth didn't perform as poorly as value. So that's a potential positive factor that the market may eventually pick up on. This is the high beta ratio against the S&P 500 equal weight. When this is going up, that means that folks are willing to get into more risk-on investments, meaning stocks. Well, this is starting to come back down, so they're getting out of stocks and going into bonds, as I've already stated. This next chart is similar to the VIX. When it's going up, that means there's fear. When it's going down, that means there's less fear. We didn't really spike up all that much, but this is going a bit higher. We had an extreme down reading with our advanced decline ratio after Thursday. Well, we're still getting that extreme reading after Friday, even though it bounced up slightly. The Stochk RSI and the Williams percent R remain extreme negative. The force index has hit the lower Keltner band, and that means that we've gone down pretty far, pretty fast on a short-term basis. Also, our stochastic study shows short-term we're extreme negative. We're getting extreme negative with the intermediate term, and we're still declining with the long-term stochastic. Going back 5 periods with our rate of change, we're starting to show where we've gone down pretty far, pretty fast. Also, with the Keltner bands placed at 1, 2, and 3 standard deviations, we're getting down to the lower third standard deviation, which again can suggest that we've gone down pretty far, pretty fast. The moving average tree, we've kind of left all the moving averages in the dust as the market heads lower. The RSI 14 is negative because it's below 50 and declining, but the RSI 9 period is starting to get extreme negative, but we could still go lower than this. This is kind of interesting with our anchored moving average from the all-time high in blue on the top. Well, we're coming down to the anchored moving average from the March 2020 low. That's the COVID low. So far, we might be holding with some support here, even though we closed down slightly below that. The parabolic SAR, which had switched to negative after Thursday, continues to be negative with the dots on top. Shaken oscillator, still headed lower and starting to get to what could be an extreme negative reading, but we're not necessarily there yet. The PMO study showing the percent of PMOs that are rising is now extreme negative. The buy signals are extreme negative, and we're declining with the percent of PMOs that are above zero. That's inside of the S&P 500. Swindle trading oscillator based on price and volume continue to decline, and they're both below zero. Bullish percent index, as we were going down, we're finally breaking out a little bit to the downside here, so this is more negative and does have more room to fall. Same thing is true with the NYSE bullish percent index. We're really showing a breakdown here, but it could go quite a bit lower before we get to an extreme negative reading. The Chaikin money flow continues to be negative and is declining. Our moving average study shows we're extreme negative with the 20. Now we're getting extreme negative with the 50, and we're still declining with the 200. The CCI 14 and the CCI 20 are also extreme negative. Balance of power is negative and still has more room to fall before it could be giving us an extreme negative reading. TTM squeeze, we still have the darker red bars here that are declining, so that's negative. The go, no-go continues to have a deep purple look, and that's negative. We're continuing to break down with our short-term fib level. We have a double fib support level here at about the 38.65 level or so. It's kind of hard to read these numbers. If we continue to fall, we'll see if that provides some kind of support. And this is measuring from the August high down to the October low, as well as the September high down to the October low, and we have these two fib lines right on top of each other. With our longer term fib chart, we're just in free fall now. There's no support levels until we go all the way back down to the October lows. Some of the things that I've been seeing suggest that we might go back and test these December lows. Well, we're getting pretty close to that. If we come down to this level at about 3,800, are we going to fall down below it? Are we going to come down here and then bounce up? But we are getting to an extreme oversold condition, and we're coming into these levels where sometimes buyers like to come in and start scooping up stocks. The longer-term fib chart going from the COVID low all the way to the all-time high, and then a significant low that was set back in 2020 that measures up to the all-time high, still shows that we have some support at about the 38.26 level. Haven't shown this chart in a while. We're starting to drop below the midpoint of our trend channel going all the way back to 2009. Ichimoku cloud shows that we're now breaking below the green cloud, so support is not holding. The Elder Impulse system for the S&P continues to be negative. McClellan oscillator also extreme negative, and then our broader measure is also getting extreme negative. The summation index based on price and volume are declining and below zero, so that's negative. The new highs, new lows, we're seeing a breakout in the new lows, so our 5 period and our 10 period continue to decline. The advanced decline line based on price and volume are turning more negative as we continue below the moving averages. We're starting to get a little extreme with our 19-day exponential moving average at the advanced decline ratio. The red line is not there yet, but it is falling, so we're extreme in the short term and we're negative in the intermediate term. Accumulation distribution also is turning more negative since we're below the moving average. Volume has picked up over the last 2 days, and we see that in this indicator. The Heikin Ashi continues to be negative with black candles. The Kegi is also negative with a red line going down. The Renko added another red box, so that is negative. The 3-line break has black bars. We added another 0 with the point and figure chart, but we have not generated any kind of a new signal, at least yet. Here's the financial sector to the S&P 500 showing how it's really been underperforming. Even though the S&P is going down, financials have been going down a lot more. The Dow also broke below its 200-day moving average on Thursday. It's continuing to decline and drop below this S1 pivot level on Friday. The diamonds continue to be negative, and the NASDAQ, which is getting really close to a golden cross now that we're seeing some real price weakness, it came down to this support level, and so far that is holding. The NASDAQ 100 also dropping down below its 50 and 200-day moving averages, getting near a golden cross, but price is going the wrong way for that. The Qs are negative. The small caps, which have just been getting hammered, continue to fall. They fell down through S1 on Thursday. They fell down through S2 on Friday. And the Elder Impulse system for the small caps is still negative. The small cap ratio to the S&P 500 is still showing weakness, even though it's still in an overall uptrend. The mid caps also getting hit pretty hard, fell down below its 50-period moving average on Thursday and the support level, only to fall down below this support level and the 200-day moving average on Friday. The mid caps for the Elder Impulse remain negative. Here's another look at the Russell 2000, which is also small cap, where it's really breaking down below its 200-day moving average. Up on top, we're starting to get extreme negative with the RSI, and we're declining with the MACD and now dropping below zero. So that is negative for momentum, but from an oscillator standpoint, we could be getting extreme. The home builders, this could potentially be positive as I keep looking at this chart. Even though the S&P is going down, the home builders are going down, but the ratio is holding up between the two because the home builders are doing better than the S&P. So this relationship is really dropping off. And if we get to an extreme negative reading, that could give some support to the S&P 500. But we're not there yet. Another chart that I usually only show in the intermarket analysis video just shows how stocks and bonds are having a pretty strong tendency to go in opposite directions. Bonds have been going up over the last few days as stocks have been going down. Here's the 10-year yield. After getting above 4%, it's really come back down and closed under 3.7%. These are bond prices. After going much lower, have then been spiking back up as folks are getting back into bonds. We're seeing a crossover with the MACD. That could be positive. And the RSI on top is now above 50 and advancing. So bonds are looking better right now. And that eventually could give some support to stocks. Because as bonds are going up, interest rates are going down. That can help other areas of the stock market, such as the tech sector, to give them some support. Here's a daily chart just showing how interest rates have really been going down across the board, but we still have our inverted yield curves. And Bitcoin is giving us a golden cross, but has been declining ever since. It's kind of getting caught up in this whole Silvergate bank closure, blah, blah, blah stuff that's going on. So it's kind of interesting that we're seeing a lot of golden crosses or close to golden crosses right as everything's turning quite negative. Looking at the long-term analysis, we're starting to lose this on the weekly chart of the S&P. We broke down below this trend line and the MACD is rolling over. It hasn't crossed over yet, but it's getting very close. Updating our possible positive scenarios, this is just to show how growth has been outperforming value, where the Qs have been outperforming the S&P. The discretionary, it's been getting hit hard pretty good, so that's breaking down a bit. But large cap growth to large cap value has still been holding up fairly well. And then some of our other growth value ratios, the large caps holding up, mid caps holding up, and small caps continue to hold up. All three of these are above their moving averages. That could be in the background as something positive. Haven't shown this chart in a few videos. This is the 50-period exponential moving average of the new highs minus the new lows. We've been up above the zero line, and that's positive. So this could be shaded blue, but we're starting to roll over with this indicator. Here's the actual indicator itself. That's the black EKG looking line. The red line is the line that we saw on the previous chart where it's starting to break down a bit, and this indicator is also dropping below zero. The 19-day exponential moving average of the advanced decline ratio, we're starting to get extreme negative based on price and just entering that territory based on volume. The 2-year Treasury yield, after really spiking up above 5%, is now coming back down, but we'll have to see if rates continue to fall and eventually go over and give some support to the S&P 500. The staples, even though they're spiking back up, we have this higher spike here that came up at the end of 2022 that has not really given a lot of support to stocks, even though we've been falling in this ratio. We'll keep an eye on this to see if it comes back up, and if things get really bad, we might continue to go up and even take out this spike, but that's a long way from happening right now. What's our outlook for Monday? The CPI will be released on Tuesday. Now everybody's looking forward to that one. And then on Wednesday, we'll get retail sales as well as the PPI. Technicals are negative, and just as I said before Friday's session, we're short and intermediate term oversold. Doesn't mean we're going to stop. We could still go further from here. The market can do whatever it wants, but we're starting to get to the point of some exhaustion where we may go sideways or we have the potential of seeing some kind of bounce if support somewhere in the market can be found. We don't have any economic reports coming out, so there won't be any queuing off of that. This will be pure market action on Monday. The whole list of geopolitical events that are happening right now, with inflation and interest rates still being the real scenario the market is fixated on, and then this banking issue that may go away pretty soon. It may lead to something even bigger. We don't really know yet. Looking at the Fed speak for the upcoming week, we only have one scheduled speech, and that'll be happening in Hawaii. That sounds really difficult to endure. It'll be by Governor Michelle Bowman, talking about modernizing the U.S. banking system, but that will come at 5:20 p.m. Eastern Time, well after the market has closed. Looking at the Stock Trader Almanac statistics for Monday, March 13th, we're a little more positive with our statistics, where the Dow is up 57.1% of the time. That's neutral to positive. Where the S&P and the NASDAQ, they're more positive, up 66.7% of the time. And then all of the other areas that do provide a positive backdrop, even though we're not seeing that in the market currently. This is the 9th trading day on Monday, where we do have a tendency to go up from the 8th day to the 9th day. Historically, we have tended to see a decline from day 8 to day 9. The fact that we're in the pre-election cycle may give some support to the market on Monday. We're also in a seasonally favorable time with the pre-election that's right now coming after the midterm bear market that we saw. We're following this gray line, which tends to be positive. And even this line is not straight up. There are some real bumps along the way. And then we're into that sweet spot for the S&P 500 historically, where it has performed well during this period of time that we're in. Looking at our scenarios, can't really go with the down one right now because our ADX is still below 20. Now, if you're more aggressive, you might jump on that sooner than other folks might do. But please be warned that we are in a short-term extreme negative environment, even though the technicals are negative. We can't go with the up one because everything is pointing down right now. We still default over to the sideways trend because the ADX, even though it's strengthening, is still below 20 overall, and the red line's on top, so it is negative. So our conclusion, the S&P 500 is negative, but it's getting oversold in the short and intermediate term. In the short term, it's also negative but oversold. Same with the intermediate term. Looking at the long term, we're now negative because we're below the 200-day simple moving average, even though we've had a recent golden cross. Thank you. I hope you have a really nice weekend. I will be preparing the weekly video, the intermarket analysis video, the deep dive video, and the supplemental video between the start of the weekend and the open of trading on Monday.